All right, everyone, welcome to a new week. Hope everybody had some good time away from the screen. Everybody had a good weekend. In terms of the week ahead, I'm not going to sugarcoat it for you guys. It's a bit of a snooze fest out there in terms of incoming events. We've got very little to get excited about in the week ahead, to be honest, but there are a few ones that could provide some volatility. But it's important to always understand the context in what you are trading in. And right now we are in the midst of the Northern Hemisphere's summertime. And why that's important to understand is because this time period usually means a lot of market participants will be taking time off their desks, taking time away from the screens. And this usually means we can expect thinner liquidity as well as lower volumes. And what that means from a market environment point of view is that can sometimes see markets trading very boring, very slow, very range bound. But because there is less liquidity, it can also mean that if we were to get big news hitting the wires, we can see some outsized, exacerbated reactions, if you will. Now, what's most important, I reckon, from a trader point of view about these types of liquidity conditions is that thinner liquidity and those lower volumes oftentimes sees liquidity providers tighten their risk profiles. So that could in some cases mean things like higher spreads. It could mean higher swaps. It could also mean more slippage. So it's worth just keeping that in mind for the next few weeks at least, as we go through the Northern Hemisphere summertime. Now, before we jump into the new week, maybe it's a quick idea just to take a step back and see where we traded across the board last week across major asset classes. Let's start with equities. I mean, a solid week for equities across the board. Almost everything traded or finished the week in the green. We did have the Dow finishing basically flat and the Euro Stoxx 50 trading slightly in the red, but everything else had a really good week. In terms of US equity futures, once again, all-time highs hit for both the S&P as well as the NASDAQ. You've got to love to see it, especially from a long-only account point of view or perspective. And I mean, we had all-time highs despite the hotter US headline CPI that we had. Not even that was enough to stop the train. We had solid US earnings. We had really good data coming out of the US with the labor market data in terms of initial claims data, as well as the consumer spending data, retail sales. Both of them just kind of pushing out some of the fears of the state of the economy. And overall, just a solid performance for equities last week. In terms of commodity markets, even though we saw some big moves in the likes of platinum and obviously downside in oil, there was very little driving these markets. I mean, if you take a look at things like gold, things like copper, things like silver, we were basically flat on the week. Now, we had some big directional moves in the short term, right? If you take a look at things like gold, big spikes up, big moves lower. Same story for oil, big moves up, then big moves lower. But for the most part, if you take a look at where we started last week and where we ended, it's basically very close to flat for some of these markets. So very little to get excited about. Now, there were some big moves in silver as well as platinum the week before, which was apparently driven by some big dislocations between physical as well as futures pricing. We had something very similar happen to gold, if you guys recall, a couple of weeks ago. Now, this also saw some spikes in things like spreads and swaps on those assets, as I'm sure most of you who trade those things would have seen. So definitely something just worth keeping in mind going into the next couple of sessions as well. Now, in terms of FX markets, I mean, the dollar was the best performing currency among the majors last week. The Aussie was the weakest. Now, for the dollar, in terms of dollar strength, mostly driven by that CPI data. If we quickly take a look at that CPI data, even though core CPI printed below consensus expectations, core CPI still moved higher, right? From 2.8 to 2.9. We obviously had a big pop to the upside in the headline number. The main focus, though, and why the dollar mostly strengthened was because we got the first glimpse that the tariff costs are starting to make their way into consumer prices, because we had core goods, which is our cleanest read on tariff pass-through, coming in at 0.7%. Now, that gave dollar bears some reasons to just trim some of that very big short positioning that's been built up in the US dollar. It was a good move for the US dollar, especially the dollar index had a nice run to the upside on the back of that. Now, then we hit a couple of speed bumps, right? We can see these big volatile moves that happen. Why did this happen? It happened because of the continued nonsense between Trump and Powell. There were some reports on Wednesday, which is this move to the downside, that apparently President Trump had drafted a letter to fire Fed Chair Powell, which caused immediate downside in the dollar. But the dollar managed to recoup all of those losses, basically because Trump came out later denying the news. The dollar also saw some downside on Friday as Fed's Waller, one of the FOMC members, took a much more dovish stance than previously, basically saying that he would prefer the Fed just to cut rates now in July, calling it, a insurance cut. Now, his comments were surprising at first because by saying that, he is at a drastically different opinion scale compared to the majority of the other Fed members, right? Everybody else is leaning neutral in terms of policy. He is a very big outlier on the dovish side. Most of his colleagues think it's a better option right now just to wait for more info, to wait for more data, to even think about cutting rates. However, when you realize that Waller is one of the people who has been mentioned as a possible candidate to replace Fed Chair Powell, then all of a sudden the dovish shift makes sense, right? The fact that he's so much more dovish than anybody else, it just makes sense. And people sometimes wonder why I dislike so many central bankers. You don't have to ask when you see these things happen. But anyway, despite this, the dollar still managed to finish the week fairly strong, I would say. Solid move to the upside. Now, the weaker one, the Aussie dollar. Why did we see the Aussie dollar trade more bleak? Mostly on the back of that bad jobs data that we had on Thursday, right? If we take a look at the data, the economy only managed to add 2,000 jobs in June. And apart from that, full-time employment actually saw a contraction of 38,000. Now, we also saw the unemployment rate move up to 4.3%, but that was mostly because the participation rate increased as well. But, regardless of this, what the miss in the jobs data has done is it's basically just given markets more reason to believe the RBA could be behind the curve and basically stuck to their view that rates are coming down from here, right? Obviously, assuming that the quarterly CPI data that the RBA is waiting for also moves down. But as long as that's the case, it should be wheels up in terms of rates going down, basically. Now, this also falls in line with my current view, as most of you will know, of downside expectations for the Aussie Kiwi. We gave this some fair chance of the recent push to the upside to pull back, giving us basically waiting for a reason to get back into shorts, and I did so on the back of the jobs data. Now, that also brings us to the first risk event for the week ahead, which frustratingly falls on Sunday, which is today. For whatever reason, New Zealand decided to release the Q2 CPI data on Sunday, like I said, which is today for me. This means the data will be out by the time most of you watch this. Now, what are markets expecting from this? Expectations is for the quarterly number to come in at 0.6%, which if we got that number means that the year over year will be pushed up from 2.5 up to 2.8. Now, this isn't massively outside the RBA's expectations. This is fairly much close to what they anticipated. And for those who are currently short the Aussie Kiwi, if we get a print anywhere close to these numbers, I don't think that will be a challenge for the trade. I think markets are still very comfortable in terms of their pricing right now for the RBNZ. They're still comfortably pricing in one more cut for the bank by the end of the year. And if we get inflation coming in fairly close to expectations, it shouldn't derail that view for either the RBNZ or the markets, which means we shouldn't really expect any big volatility. The big risk, obviously, for those who are short this like I am right now is if we see CPI coming in massively low, right? If CPI surprises massively to the downside, that can obviously weaken the Kiwi. It could push the Aussie Kiwi up. That is a possible risk. And obviously, the best case scenario is that we get inflation actually coming in hotter than expected. Because if that's the case, it could be enough for the markets to start trimming down their expectations for that additional cut for the RBNZ, and that could be really good for the trade. So just keep that in mind. The one thing that is still making me a bit uncomfortable about the trade as well, and that is obviously another risk we need to watch for CPI, is the fact that positioning is still very, very stretched in the opposite side here. The market is massively stretched on the Aussie dollar. They are on the short side, and massively stretched for the Kiwi on the long side, right? So that is a bit of a risk. If we do get, a very shockingly low number, then maybe that could see a bit of a squeeze develop for the pair. So that's definitely something just worth, keeping on the radar as well. Now, the one thing that isn't on the calendar that we also get over the weekend is Japan's upper house elections. Now, this one has been getting a bit more attention than usual because the markets, at least from a consensus point of view, believes that there's a decent chance that PM Ishiba's LDP party will fall short of the 50 seats that they need to keep their majority in the upper house. Now, if they land around 40 to 49 seats, which right now seems to be consensus, it basically puts them in a gridlock. That doesn't necessarily mean that he needs to go immediately if that happens, but normally, if they lose majority, you don't see those guys sticking around for long. Within a month or two, they're normally out. So that is a bit of a risk. Polls right now, at least the exit polls, are hinting that it looks like they're not going to be able to meet that 50 seats that they need. Now, in terms of possible reactions here, look, Japanese yields. If we quickly take a look at 10 years, they have been grinding higher over the course of the last few weeks now. The main reason for that was in anticipation that if the LDP can't make that majority, if they lose that majority, that they would need to, in terms of obviously working with other parties, it will open the door to more tax cuts and more fiscal spending. Now, obviously, the extent of the loss and the extent of how that opens the door for cuts on the tax side, for fiscal stimulus, that's where the main focus will be. The worst case scenario for us trading this, now I'm not going to trade it, but the worst case scenario for those who wants to trade it is if the government was to lose their majority, but only by a small margin, like they need 50 seats. So if they get like 45 to 49, that's basically in line with consensus. And the outcome of that varies so much that there's really no point in looking for a trade, in my honest opinion. I think the political uncertainty of a gridlock makes it not very attractive because you just don't know which way it's going to go. Will Ishiba stay? Will he be ousted? What type of coalitions will they form? With who will they form it? There's so much unknowns there. It's just not worth, the effort, worth the risk trying to pick a trade on that. I think the best case scenario for the yen specifically would be like an outright majority victory when nobody is expecting it, right? If they win much more than 50 seats, that would basically mean Ishiba doesn't have to worry. You can carry on as you were. The BOJ can carry on as they were. And that means that hikes are still possible and there's very little political uncertainty. The worst case scenario for the yen would be like a massive loss, right? Not only like 40 seats, but imagine they get 30 or 25. That would be really bad because that will open the door very wide to huge increases in fiscal spending, massive tax cuts. Now, in most cases, this outcome would be yen negative, right? On the other side, tax cuts and increased spending should be good for growth, right? Which should be good for the economy and it should be good for hikes. But keep in mind, like unlike other economies where the central bank is more independent, when it comes to the BOJ, they will do the government's bidding. So if they have a government that comes in that says, no, more stimulus, they can basically tell the BOJ, hey, no more hikes for now. You need to stand pat. And that can obviously be a yen negative as well. So bottom line is, if it's a massive, massive loss for them, that's probably yen negative. But personally, as you guys know, I've got very little interest to trade the yen on BOJ or political influences because these guys just can't make their minds up. They change their story every day. So that's not one for me, definitely. But it's one worth keeping in mind for those of you running risk on the yen. Now, the other, I would say, major event, which again isn't one that anybody's excited about really, is the ECB policy decision. The broad expectation for this, a whole lot of nothing, right? The ECB is widely expected to leave rates on hold. and the markets will, as usually will be more focused on what the bank has to say about forward guidance. Now, why aren't markets expecting any cuts from them? The reason for that is the bank obviously cut back in June, and everyone pretty much agrees that they have time to just sit on their hands right now. Lagarde even said at the last meeting that they're in a good position to give themselves some time. Markets are currently toying between the idea whether we're going to get a September cut or rather October cut or a December cut. That's probably not going to be changed in terms of this meeting. We've also heard from quite a few officials recently that they're comfortable basically just kicking the can down the road. So there's really nothing new for the bank to talk about. They shouldn't be in a rush right now. Why? Because inflation is close to target. They don't have to stress about too low or too high inflation. Growth isn't great, but it's not terrible. Wages are slowing down. And obviously tariff risks is back on the horizon with the threat of President Trump saying he's going to add 30% tariffs from, the 1st of August. We'll see if that happens or not, obviously. So there's very little incentive for the ECB to ruffle any feathers this week. What markets will be paying attention to, if in case we get something like that, will be if they are sounding concerned about the strength of the euro. It's unlikely that they will always come out and say, listen, we don't target the exchange rate. But we have recently heard from the likes of de Guindos, Vice President de Guindos, coming out saying, hey, we're not too concerned about the euro dollar, but if we were to get to 120, that'll be problematic, in his words. So I'm not expecting anything from Lagarde on this, but if she was to come out and she says, oh yeah, we're concerned about the strength of the euro, then obviously we can expect some weakness playing out for the euro on the back of that. But again, it's very unlikely we get anything that's market moving coming out of that. But that, in my opinion, will probably be the biggest focus for the market, is whether they talk down the currency, and obviously, whether they talk up inflation risks. Right? If they sound a lot more hawkish, saying things like, hey, listen, because of this new tariff risk, we might not even be cutting rates at all again this year. That can obviously be more positive for the euro. But again, both of those two outcomes, I think, is highly unlikely for the week ahead. Now, what we also get, as always, during this early part of the quarter is earnings season. We can't forget that this week, as well as next week, we've got a lot of those big Mag 7 stock names coming up. This week specifically, we've got both Tesla as well as Alphabet, both of them reporting on Wednesday after market. In terms of Alphabet or Google, look, the focus on this one, the company crushed expectations last quarter. The bar is a little bit higher, I would say, this quarter. Analysts are still expecting solid growth with strong contributions coming from cloud, obviously, and steady search ad revenue. But the big focus, the big buzzword will be AI, right? How is Gemini evolving? How is it being integrated into search and YouTube? All of those types of things, how it's going to expected to help or hurt core businesses. Those will be the focus points, and obviously the numbers itself. In terms of levels to watch, we've got the 200-day moving average coming up at around the 173, and we've got the weekly implied volatility low at around the 176 and high around the 192. So very key levels there to watch for Google. In terms of Tesla, look, Q1 was a mess for Tesla. Big drop in revenue. We obviously had management pulling full year guidance. That was for many companies did that, to be fair. But again, they had reason to do it. Now, since then, deliveries have continued to disappoint. We've got Elon's public battles, political and otherwise, obviously not helping sentiment either. So from this print, I think it's going to be less about the rear view and more about what's next, and what they have to say about incoming plans and what they plan, how they plan to fix things will probably be the biggest focus point, if anything, for Tesla. In terms of key levels, 200-day moving average around the 317. We've got that May high as well as June low around the 273 and 368 respectively. We've got the implied volatility low for the week at around 306 and high at around 350. those will be key levels to watch for those two stock names. In terms of current positions on my side, like I said, Aussie Kiwi still running shorts there. I'm happy to keep that running. Still running dollar longs as well. See no point in really closing that down. Now, we've got a couple of other risk factors that we need to watch as well. We've got a speech coming up from Governor Bailey. That'll be interesting. We've got one from Fed Chair Powell as well. Now, strangely, I've seen a couple of people talking about, what is Powell going to talk about? Could he be potentially saying that he's going to step back down? Look, if Powell comes out and he surprises everybody by saying, I'm stepping down, that's going to be massively bad for things like the dollar. It's going to be bad for things like equities. It's going to be bad for things like treasuries. That's a massive risk if we get that. But keep in mind, this speech is not a policy speech. The Fed right now has moved into their blackout period, meaning that they won't be talking to anybody publicly about monetary policy until the meeting is out of the way. So it'll be very strange, if Powell comes out and talks about policy. He's not allowed really to do that. Obviously, if he's fed up and he uses that to voice that he's thinking about stepping down, like I said, that's going to have big reactions in the market. That is one to watch, but I think it's unlikely. I think Powell will stick to the rules basically and not want to freak people out on that one. The other one we have to watch is a new fresh batch of flash PMI data. Now, I've said this many times over the last few weeks now, months now. Normally, this data is super impactful. It can be very meaningful, very volatile. In the current context, though, the market just doesn't care about this data at the moment because we don't know what's going to happen to tariffs, right? 1 month it's on, 1 month it's off. 1 month it's 10%, then it's 30%. Who the hell knows what's going to happen next? It's so difficult to trust this data. I think the best case scenario that we could hope for a possible volatile move is if European and UK data comes in really, really bad for whatever reason, and US data comes in really, really good, because I think that just feeds into that current theme of dollar upside. It feeds into more squeeze potential on the positioning side because the market is still very long the euro. They are still very short the dollar. That would be my preferred way to look for upside in the dollar if we see that happen. But again, I don't think that's going to be worth short-term tradable opportunities. It's just too risky at this stage, and I don't think the markets really trust that data. The other one to watch would be Tokyo CPI, which is normally seen as a bit of a forward-looking indicator for national CPI for Japan, but the main focus, this will probably be overshadowed by whatever happens to the Japanese election. So just keep that in mind. So with that said, hope everybody will have a fantastic week ahead. And as always, any questions, don't hesitate to let me know.